Welcome to the tutorial video on investing in private mortgages, as presented by Private Investment Results Group. Over the course of this video, you will learn what private mortgages are, how they fit in compared to other types of investments, and even our special twist on how they can be implemented. We hope that by the end of the tutorial, you will have a better understanding of them and be able to determine if they might be a solution for you. Furthermore, in the interest of providing more thorough education, for the first several minutes, we will discuss the current state of things, as well as what to look for in an ideal investment, which we hope will set the stage to better assess private mortgage lending. So let's just jump right in and take a look a bit at where we are now. How do you actually achieve the growth that you're seeking in this economy? Is it really possible? Well, certainly the national economy presents a challenging environment for most investors. For the last 4 or so years, we've been in an economic funk, with layoffs and recession initially, followed by a couple years of very anemic growth, or no growth at all. Some economists even think we may re-enter another downturn in the coming months. Stocks have been very volatile, and real estate is regularly blamed for being one of the first dominoes that led to the downturn. Commodities, oil and gas, gold and silver, everything has been affected, and the pieces are constantly changing. Furthermore, given the growing national deficit, ongoing upheaval in Europe and in the Middle East, and the inflationary pressures on gas prices, food, and other everyday purchases, it's easy to struggle to make sense of it all. As a response to this complexity, many investors end up reacting with one of two different responses. First, many hunker down and try to isolate themselves from the chaos. Unfortunately, as we all know, this is not the path to growth. Furthermore, over time, the proverbial hiding the money under the mattress approach tends to leave investors fully exposed to the most wealth-destroying of all events, inflation. Since 1913, the value of the US dollar has decreased over 95% due to inflation. So we know that to actually achieve true growth, we must beat inflation. In comparison to this, other investors, perhaps having lost money in the early years of the recession, want to make up for lost time and take unnecessary risks in trying to win big gains. Our philosophy is based on the fact that most investors don't really desire to be in either of these two groups and are seeking a better alternative, and it's our hope that this video will help you understand other great opportunities out there. Before we dig in too far in the details, I would like to take just a moment to tell you a little bit more about Private Investment Results Group. It's always wise to know something about the sources of any of your information. My name is Scott Thiering, and I'm the founder of the company. I have more than a decade experience as a principal investor in a variety of real estate property types, from residential to commercial, retail, and office, as well as joint venturing on private businesses. Many of the other members of our team, both formal and informal, also have decades of experience as well. My background is actually as an engineer, and I received my PhD in engineering from Northwestern University outside Chicago in Evanston, Illinois. I also minored in management and finance. I found that this combination of education has afforded me with a strong skill set and analytical mindset to crunch the numbers and evaluate exceptional investment opportunities. As such, I've strived to become a real student of investments with above-market returns and low and controlled risks. Private Investment Results Group has several areas of concentration. One of the first things we focus on is education. We know that every investor will only feel comfortable investing in something that he or she understands. Meanwhile, we continue to find many opportunities to invest beyond the bread and butter investments everyone knows about. So through education, we strive to bridge the gap and provide the information necessary for investors to make wise decisions. Of course, this video is part of that process. Next, we concentrate on the private mortgage lending, and as we will see later in this tutorial, a safer niche within the broad area of private mortgages. Finally, Private Investment Results Group also assesses investment and joint venture opportunities with existing private businesses. Our affiliates also have a couple areas of expertise that are synergistic with Private Investment Results Group. The first of these is in the ownership and investment in commercial and residential real estate. In these cases, the investor owns the real estate rather than lending on the private mortgage. Finally, many people are unaware that retirement funds in the form of IRAs and 401ks are eligible to be used for a wide variety of investments beyond the typical stocks, bonds, and mutual funds. Our affiliate helps people gain the freedom over their own funds so that they are able to invest their retirement funds over the full expanded range of investment choices allowed by the IRS. Feel free to inquire with us if your IRAs or 401ks are currently trapped and the limited investments available through retirement accounts offered by banks and brokerages. To see how an investment stacks up, let's now think about your current investment choices and how you're allocating your savings. The first question you should ask yourself is, are you satisfied with your current investment returns? Clearly, if you're watching this video, you're probably thinking there might be better opportunities out there. Let's think about a few specific places where you might have savings in investment funds. We'll start with your bank savings or money market accounts, where you're probably making 0.25% interest. What about your brokerage accounts? Are they providing you the returns you are seeking for the risks you are taking? Are they providing income? How is the performance of your 401k or IRA accounts? Are they achieving the growth in income that you are hoping for? Are they putting you on a path that will provide for a secure future? Also realize that all your accounts are invested in something, even if it's just the US dollar sitting there idle in a money market fund. Or maybe you are invested in a variety of things, which leads us to the next question, which is, are you satisfied with your current investment choices? CDs, as you know, all but those tying up your money for many years, lose out to inflation. What about stocks and bonds? Stocks have been a roller coaster ride over the last couple of years. Bonds, on the other hand, tend to be a bit more slow and steady, but with interest rates poised for going up over the next couple of years, the value of existing bonds are likely to go in the opposite direction. Mutual funds, on the other hand, can be all over the place, but you're paying large fees every year, whether they go up or down, and most of the time, you're not getting your money's worth. Most mutual funds regularly lose out to a set of stocks chosen by throwing darts at the business section of the newspaper. How can that make sense for achieving your future dreams? These concepts are put into numbers on the chart to the right. As shown, according to Morningstar, the average mutual fund concentrating on large companies only returned about 0.1% return over the last 5 years. Funds dedicated to small companies didn't fare much better at a mere 1.3%. Immediate government bond funds performed somewhat better, but they are unlikely to do even that well as interest rates head back up. Thus, as you contemplate whether you're satisfied with your current investment choices, let's ask a few more questions. Are they safe? Sure, CDs would be. But what about stocks, bonds, and mutual funds? Safety is not really what they're known for. And are they reliable? Are they consistently providing significant income? More than a couple percent per year? Can you count on that every month or quarter? Are you sure they will be there? And of course, the last question is, are you even beating inflation with that income? Most bank savings, CDs, bond funds, and dividend-paying stocks or stock funds, your returns are below inflation. And therefore, for many of those investments, your value is going down and down every year, and yet you think you're saving for the future. This is not a way to get toward retirement or provide for you in retirement. Are you really stuck with just these options? Well, obviously, if you're watching this video, the answer to that is no. But you wouldn't know it by reading most traditional personal finance magazines or newspapers. In fact, a recent survey of people with self-made wealth asked the participants which categories of investments they were using: stocks, CDs, exchange-traded funds, or mutual funds, as if those were the only options. Therefore, many people are less familiar with solutions outside of banking and Wall Street, and this is where most people, and possibly you, have likely come from so far. And a quick look at the example returns in the chart shows how important it is to beat the typical returns of the last 5 years, and why we hope you will find education like this tutorial to be so valuable. Retirement. For most people, this is the dominant financial event of their lifetimes. Whether for you it's still a bit in the future, approaching quickly and looming large like an upcoming thunderstorm, or you're already retired and trying to make your investments last into the future, it is a concern for nearly every American. Just quickly, I'm going to run through a few statistics, and they paint a pretty grim view of the future for many retirees and near retirees. 67% of people who are currently retired are worried about their long-term financial futures. That's 2/3. Moreover, more than a third of baby boomers feel they are totally unprepared for retirement. The baby boomer generation is in the midst of reaching retirement age, with 10,000 more getting there every day. A third of them are totally unprepared. Meanwhile, 74% of non-retirees expect to work past their retirement age in order to keep financing their lifestyle. So much for calling it retirement if 3/4 of them have to keep working. Finally, there is the sobering statistic that we as Americans are finally starting to realize, that Social Security can't be our retirement plan A. A recent survey indicated that the majority of retirees expect Social Security benefits to be cut as they get older, and 60% of non-retirees predict Social Security won't be able to pay them benefits when they finally stop working. So the question for you is your current course of action, whatever you're doing, going to get you to your golden years? Or if you're already retired, will your current investments keep you on track to keep them golden? Or will they turn into something closer to the lead-weight years? Don't just be a statistic. If you're not on a path to growth and prosperity, it is up to you to do something different. So as you open yourself up to the idea of other opportunities and expanding beyond the typical ones like stocks and bonds, what questions should you be asking yourself? What we are trying to set up are a series of questions that help you identify an ideal investment. Realize too that these questions really can be applied to any investment. Now, of course, all real investments may have attributes that are non-ideal, but we should at least ask ourselves some questions that would help identify what an ideal investment might look like. The first question, of course, is my principal safe? No one wants to lose their hard-earned money. It takes time and effort to get it. You have to make sure you protect it. You want to have an investment that protects your principal. So this leads us to the fundamental aspects of the structure. Is the investment structure designed to minimize risk? Let's go back to a CD. This is clearly an investment structured to minimize risk. Not only is the bank protecting it, but it is likely also covered by the FDIC insurance. What about comparing that to stocks and bonds? How is buying a stock structured to minimize your risk? Well, it's not really. You buy one and hope it goes up or pays a dividend. There are things you can personally do to try to minimize the risk. You can do fundamental research to understand the details of the company and its market. However, there is nothing inherent to the structure of a stock investment that's protecting you. And as such, 100% of your money is at risk. Finally, are you the first or last to get paid? For the case of a stock that is going up or down, you are just going along for the ride. But in the case of the dividend, the stockholder is the last to get paid. First, the company has got to make a profit, then it has to decide to distribute some of those profits, and finally, then you can get a dividend a few months later and receive some income from that. This is obviously a case where you are the last to get paid. So ideally, you'd find an investment structured differently than this, where you are the first to get paid. The next question you should be asking yourself about any investment is, will it provide a good return? We all understand the whole reason you'd be investing is to make money. However your money is invested, you want it to be working for you. An ideal investment would also provide you with above-market returns, and of course you'll at least want to beat inflation. In this regard, most people probably understand that the United States currently officially has fairly benign inflation. However, looking forward, there are good reasons to have concern that the inflation we will experience going into the future will be higher. Furthermore, despite the fact the official government CPI figures indicate that inflation is not that great, we can certainly see in food prices and gas prices and other items that are related to real commodities that inflation is definitely occurring. I bring this up mostly because these facts put even more pressure on whatever you're doing to invest, since your investments need to outpace inflation to achieve any real gain on your investment. So really the goal would be to find an investment with the best risk to reward ratio, where you achieve the maximum safety and get a good return at the same time. And while we've all heard this adage before, as you've likely experienced, the trickier part is actually achieving it. Let's just keep going with this. and dig a little deeper and think about what else it would take to consider something to be an ideal investment. The next question you should be considering as you investigate an investment opportunity is, can you understand it? Many investment advisors provide the advice that you should only invest in something you can understand and explain to someone else. We think this suggestion is sound, and you'll sleep a lot better at night knowing that you understand what it is your money is invested in. The next question is, does overseeing the investment become another full-time job? If you want to become a stock day trader or have to respond to every tick of the news cycle for an investment to deliver success to you, is that really what you want? Would it even be realistic to be able to keep this up? So an ideal investment would be easy to implement and would not require large amounts of your time to monitor it. What about dependability? An ideal investment would be dependable. CDs, yes. Stocks, not so much. I would suggest the reputation is quite the opposite. Even with dividend-paying stocks, you cannot really be sure what the dividend will be each quarter. And millions of people guess wrong on the direction of a stock's appreciation every week. That's why they move up and down. Someone is guessing right and someone is guessing wrong. Moreover, if a stock does go down and you lose principal, how does that affect your portfolio? What about being able to add money or get some back? An ideal investment would have some ability to be somewhat liquid, such that you would not be locked into something for many years in a row. While most stocks are quite liquid, this is certainly a place where the limited liquidity of traditional real estate investing suffers. The next question is, are everyone's interests aligned? A key example where this may not be the case is with a stockbroker recommending a stock. How do you know what the stockbroker's interests are, and are they aligned with yours, or is the recommendation all just about trying to get a commission? Therefore, for an ideal investment, everyone's interest must be aligned, and everyone affiliated with the investment is working together for success. Communication is also key. Will you be kept informed as to how the investment is doing and what is new with it? Do you have access to the actual people making the decisions? Think about it this way. When was the last time you emailed or talked to the CEO of a Fortune 500 company? It is important that you are able to reach out to the right people. Finally, is everyone working with you living by high integrity? Again, this points to the trust factor, and you must be comfortable with whomever you work with on any investment you choose to make. Choices for investments. We obviously have discussed the first category already, so we won't say anything further on these. More complex instruments like options and futures can certainly be profitable. However, many times implementing them properly is like another full-time job, and if you're not a pro, you might as well be going to Vegas. On the other hand, in light of the potential for inflation in the United States, precious metals may have a place for a lot of people, at least for a portion of their portfolio. We won't be discussing those here, but there are prudent minds who believe that there is some value in owning precious metals. The next two categories are areas where Private Investment Results Group participates. The first, investment in joint venturing in private businesses, is not something being discussed today in this tutorial, but the concept is straightforward in that if you invest in growing businesses, building the legendary Better Mousetrap, it can be very lucrative. The key, of course, is to make sure that necessary due diligence has been conducted to really understand the business, and this is what enables an investor to make an informed decision. As you can imagine, this can become quite time-consuming and is not necessarily the right thing for an individual investor striking off on one's own. The details of our approach are well beyond what we'll want to discuss in this tutorial, but do entail a careful and conservative method for minimizing risk, which otherwise tends to be the Achilles heel of this type of investing. Of course, the main focus of our discussion today is real estate. Hopefully this long introduction has provided you with a good baseline and has got you thinking about how all these pieces fit together, and it will make it easier to appreciate private mortgages within the broad real estate umbrella as well. As you watch the remainder of this video, reflect back on the notion that we have been describing as an ideal investment, and you will see that the unique niche that we are focusing on matches very well, which of course is why we are so excited to presenting it to you today. We all know that many people have become wealthy investing in real estate. There are two main ways to do that. The first is you can have an active real estate investor, like the landlord. In this case, you need to have a high degree of expertise to properly find and manage the properties. It also typically gets time-consuming, both initially when you seek the investment, but also because it is a long-term commitment of effort. You have to worry about the 3 T's: the tenants, the toilets, and the trash. Alternatively, you can go with a passive investment. You still must choose the right investment, but you can end up with many of the benefits without the hassles. We also find that a feature that greatly appeals to passive investors is that it's mailbox money. The income or returns just show up in your mailbox and you cash a check. For most people, if you can find the right opportunity, passive investing is the best and easier choice. And as we will be describing next, if you do it correctly, private mortgages can be a great way to invest passively. So what is a private mortgage? A private mortgage is essentially when an individual or group or entity makes a loan on real estate, that is, a piece of property, that's collateralized by a mortgage or deed of trust. Now, a mortgage or deed of trust are fundamentally the same thing, but different states have different names for the same concept. As you might expect, just like a mortgage the bank could make, a private lender's collateralized mortgage has certain rights over the property too, and we will touch upon that later. In addition, with a private mortgage, you also have a promissory note. The promissory note is a contract where it spells out the details of the obligations of the borrower and the benefits to the lender. Among these are generally an interest rate, how much the borrower is paying, and how often they pay, typically monthly or quarterly. The promissory note also includes a specific time frame. Now, most people are familiar with a 30-year or 15-year loan. In comparison, private mortgages tend to be shorter. Especially for the niche that we will be discussing throughout the remainder of this tutorial, they will be much shorter, typically 6 to 12 months, or sometimes up to 2 years. The reason for this is because we are not looking to fund a person's home for the next 30 years. Rather, we are looking to fill a specific need within the market, where we can achieve both higher return and reduce risk. Lastly, in our case, oftentimes we structure our promissory notes with special extra language to add the potential for boosting the overall value and income that comes out. I said earlier, we're not looking to make 30-year mortgages to some homeowner. If not them, who would be the borrower of a private mortgage the way we look at it? This isn't a case of grandma getting kicked out of her home or someone in the middle of the foreclosure trying desperately to save their home. Those emotional situations are really the opposite of the type of borrower we're looking for. Instead, our borrower is an experienced real estate professional. This is a developer, someone building new homes or redeveloping, a flipper, someone who's experienced in knowing the market, typically for easy-to-sell bread-and-butter homes, taking a house that's beat up, fixing it up and flipping it at market rates or near market rates, and quickly turning a profit. The third type of real estate professional is a turnaround specialist. This would be someone experienced in turnaround situations. For example, taking over a failed development or a case where there's some other straightforward fix that will yield a profit for them. Note that throughout the rest of this presentation, we will call flippers, developers, or turnaround specialists the generic term developers for simplicity, as they all serve the same niche. In any case, the borrower is always an experienced professional, and this is important because it takes a lot of emotion out of the process, since these are business people who have been doing this for years, and they understand their business, and they know what they need to do to make a profit, and they have a track record to show it. These developers can be individuals or companies, and are only considered if they are active in the market and have been screened for experience and track record. We would not recommend making a loan to some guy who watched the TV show like Flip This House and thought, hey, I can make money doing that, and he's trying to buy his first house and looking for a mortgage. That's not what we're looking for. Furthermore, in all cases, we are looking for the developer to have a well-thought-out short-term game plan to get in and out quickly. We are not looking for buy and holds. There needs to be a way for the developer to increase the value of the property through development, rehab, finishing it, some sort of construction, cleaning it up, whatever it might be to get it in and out quickly and make their profit and get us out of the loan. Ultimately, the borrower needs to be seeking loans that meet our specific criteria. Now, at this point, you might be asking yourself, why wouldn't the borrower use a bank to get a loan? Well, first of all, banks are slow. Loan approvals, getting the paperwork done. A borrower knows this is guaranteed to take at least 30 days, but 60 and 90 days are not uncommon. And of course, time is money to any developer. This will result in lost opportunities for any developer who is trying to do more than 1 or 2 deals a year. And of course, fewer deals in a year result in fewer profits in a year. Therefore, it turns out that even if the bank interest rates are cheaper, it costs them much more to waste the time dealing with the bank than using a private mortgage. Furthermore, when the developer is trying to make a purchase, offering cash makes for a much stronger offer by being able to say, I'm going to bring all cash to the deal. And any seller is going to compare an offer that's all cash to one with a nebulous contingency based on a bank mortgage and be inclined to go with the all cash offer. And a developer can make this type of offer since from the seller's perspective, a transaction with a fast private mortgage behaves the same as cash. Moreover, with a private mortgage, a developer who can make an all-cash offer is also likely to get better pricing of the deals he does, because many sellers would rather take a discount to know that an all-cash offer is really going to go through instead of the offer based on a traditional mortgage contingency that may or may not ever go through. No seller wants to find out 2 or 3 or 4 months later that the deal fell through because the buyer couldn't meet some bank requirement after all. Furthermore, banks really start scrutinizing you when you have multiple properties, and if a developer is trying to purchase multiple properties at once, then all of those mortgages showing up on the record will hinder the developer's ability to get any new ones. Meanwhile, as you probably know, ever since the credit crisis of 2008 and 2009, the banking standards for getting a loan are much more stringent. And so when you add that on top of all these other things, it really makes very little sense to go through traditional bank financing on these types of loans. So how does this all work? Well, it's designed for low risk. First and foremost, that should be the key for any type of private mortgage. So I'm sure you're asking, how is that low risk obtained? Well, first you start with a mortgage or deed of trust. And this is recorded with the county. And just like any other mortgage or deed of trust, the property acts as collateral to the loan, and the borrower is obligated to pay the loan. And if this doesn't occur, the lender, like a traditional bank, has the right to foreclose. The lender, remember that would essentially be you, the investor, also receives a promissory note, which, as I described earlier, provides the lender with a contractual rate of return. Unlike a stock or mutual fund, where any dividend payment is usually not obligatory, and as such can disappear altogether, here you have a contractual rate that's guaranteed by the promissory note. In our case, the contract interest rates are typically around 10%, depending somewhat on the overall situation. Next, the risk is minimized through protective equity. Protective equity is the value of the property over and above the amount of the loan. For our loans, we carefully avoid any situation where the mortgage is underwater. Let's touch upon that topic for just a second, because statistics show that a large percentage of the properties in the United States are actually underwater, meaning that more is owed on them to the bank or other mortgage holder than the house or building is actually worth. This is not a situation we want to get ourselves into, so we are vigilant in making certain that all the mortgages where we might lend have a significant amount of protective equity in them. One of the reasons this is possible is because the developers we work with are working on projects where the prices have already been reduced through foreclosure, bankruptcy, market correction, etc., and thus are now able to show strong value and upside. As such, our loans typically end up being only 50 to 70% of the final after repaired values of the properties. As the name implies, the protective equity is there to protect the lender. Thus, even in a case where there is a foreclosure, which is rare, and I'll discuss why shortly, the lender would have, because of the protective equity, the likelihood of actually making more money with a foreclosure than just under the regular note rate. Furthermore, because of the fact we look for loans where the developer is adding value to the property by fixing it or building on it or whatever it might be, then that protective equity increases with time. This means that a month after you've made the loan, you can actually be better protected than you are on day one, as the protective equity increases as the property value goes up. Finally, a few slides back, we talked about who gets paid first. As you know, if you've ever sold a house yourself, the mortgage is the first to be paid off. Well, actually, taxes are first, but after the state and county have received their share, the mortgage is next in line. Any profit for the developer comes after the mortgage has been fulfilled. The mortgages themselves are short-term, generally ranging from as short as 3 months or occasionally up to 2 years. This provides some degree of liquidity, as the money is not tied up nearly as long as is common for buy and hold properties. Finally, the risk is also mitigated through regular payments, and of course those provide your income throughout the duration. The next topic follows right along with that, getting paid. As you can appreciate, if you've ever had a mortgage yourself, mortgages have regular payments on them. As the lender, now you're on the receiving end. Furthermore, as I've stated, the mortgage gets paid off upon the sale of the property to the end user, and at that point you get your final interest payment as well as the remaining principal proceeds at the close of sale. Additionally, in our case, we sometimes are able to negotiate other bonuses on the back end with our borrowers. These could exhibit themselves as profit sharing or equity participation mortgages, etc. These tend to make everything synergistic with the developers because the lender ends up making more as the developer makes more. On the lender's side, this effectively increases the yield and provides a nice boost. It ends up being a win-win situation for all parties. Earlier, I promised that I'd discuss foreclosure because it is certainly on everyone's list of fears. I mentioned that this is actually pretty rare, and there are several reasons why. First of all, our borrowers are professionals who are developing and improving the properties, and if they've been screened properly, they're fairly unlikely to get themselves in hot water. Furthermore, with a large degree of protective equity that's increasing as they complete their renovations and improvements, it becomes less and less likely that developers will walk away from the project. Therefore, even if the developer is struggling to make payments up until it's sold, no developer wants to give up all the profits from the hard work that has gone into the property to the mortgage holder. Thus, the developer is going to work very hard to make sure the lender is happy so that the property does not get foreclosed upon. Finally, the last step, after the proceeds from the mortgage have been paid off, is to repeat with another new mortgage. You probably already know that the wise way to go in any investment is to already have an understanding of the exit strategy even before you start. Perhaps for stock you have a sell price, and if you achieve a certain level, you sell half of your shares, or something like that. One finds themselves in hot water if you don't have an exit strategy, if you don't have a specific reason or method for getting in or out. And financially, this can sometimes be a way to get yourself in trouble. So here, the way we use private mortgages, we have a very specific exit strategy. After the property sale, the lender, that's you the investor, is paid back. That's pretty straightforward. At this point, you have two choices. One, you can invest the proceeds back into another private mortgage so that you can keep receiving that consistent income that you've gotten used to by that point. The alternative is to request some or all the proceeds returned. This flexibility is somewhat unusual, but is a very nice level of liquidity because every 3 or 6 or 12 months, you have the chance to reevaluate whether this is the right thing for you. As you can see, the short-term nature of the loans allows the investments to be semi-liquid. This also reduces risk because over the course of a few months, the real estate market doesn't move that much. And of course, the interest rate risk is minimal as well, because if the interest rates provided by other avenues, say a bond fund, change, we are able to readjust our interest rates in just a few months as new mortgages are created, and thereby keep the relative spread in yield compared to any lower rate alternatives. Therefore, this allows this type of private mortgage to maintain strong returns relative to inflation and alternative investments, even as the market bounces around and shifts. By now, perhaps you would agree that this is a unique niche. As a tutorial on private mortgage investing, we have tried to give you an understanding of the overall concept of private mortgage investing. However, beyond that, you have now been exposed to a pretty special technique that we use to further increase our returns while simultaneously reducing risk. For us, not just any private mortgage will do. As always, risk can never be zero, and there's no such thing as a risk-free investment. Even government bonds have risk, even if it's simply the risk that you lose your money to inflation. You don't have control over inflation, and so you don't have any control over your purchasing power at the end of the bond term. So there is risk no matter what you do. In essence, the key in the case of private mortgages that I'm discussing here is to find that unique combination that protects your investment with great protective equity, adds value, and still maintains moderate term liquidity. But to really find this unique combination requires a significant level of due diligence. You need to understand the property, which is a combination of a location, its protective equity, the local market and current demand, and the ability to have a sale in a timely way. Further, you need to understand your borrower. You need to understand their experience and skills. They need to be demonstrating success in the current market. They can't just be using some kind of pie-in-the-sky numbers from 2007 before the crash as justification of how they will turn a profit. Finally, you will want them to be financially solid themselves and have a track record to show that. And in the end, after you've achieved all these things, I would venture to say that done properly, this particular niche of private mortgage investing can match up pretty close to the ideal investment that we've been discussing throughout this video. Now that we are getting toward the end of this tutorial, I would just like to summarize what we have covered and hit a few of the reasons why we are enthusiastic about our style of investing in private mortgages. First, investors are able to receive passive mailbox money. They are not required to monitor daily stock price movements or have a broker on speed dial, nor do they get calls in the middle of the night about a roof leak or a broken toilet. Investing in private mortgages also acts as a great inflation hedge. If inflation increases, the lending rate of the new private mortgages can be adjusted to ensure a high real rate of return. Furthermore, as property values increase, this helps increase the protective equity safeguarding any loan. Likewise, as we've covered, private mortgage investments provide nearly immediate income once the funds are deployed into a loan. Next, we have discussed how we are able to achieve a high rate of return fully backed by both a contract for payment and fully collateralized by a property. Because of the specialized type of borrower we are attracting, interest rates are typically around 10%. Plus, sometimes there can be additional back-end profit sharing or other bonuses. We've also described the great safety afforded by the protective equity of those properties that are being loaned on, which minimizes the likelihood of the property going into foreclosure and protects the lender in the event foreclosure does become necessary. Private mortgages also have a predetermined risk profile in that because the interest rate amounts are all contractual, there is no guess as to what payments are to be received. Another aspect that we have not talked about much is that these investments are IRA and 401k eligible and fully compliant with IRS requirements. Now, you won't be able to use your typical brokerage or bank-based retirement accounts to have this freedom, but the process is not difficult, and we do have an affiliate that can help with this aspect as well, if desired. Finally, the investors retain some liquidity over their investment dollars. Because of the short-term nature of the loans, there are opportunities to add more funds to increase payouts or pull money off the table to fund other needs without having to wait years to do so. In closing, I personally want to thank you for your time, and I will just bring back the questions from one of the first slides, which are your current investments dependably and safely providing you the returns you are seeking? And as a follow-up, will they get you to where you want to go, whether that be to grow your nest egg for retirement or provide the income you need now? If the answer to any of these questions is no, we encourage you to consider private mortgages as a potential solution to help you get steady income and above market returns. I certainly hope you have learned something today, and on behalf of Private Investment Results Group, I hope I have helped you to discover part of the new world of opportunities out there. If you'd like to learn more, here is our contact information once again. We know your time is valuable and appreciate that you have given us a little of it. We hope that you found this tutorial informative and enjoyable. Thank you.